Hey, it's Devon Naika from Retirement Wellness SA. In this video of the series Life Cover Secrets, I want to talk to you about the fine print. In fact, I want to magnify the fine print. Now, have you heard of instances where the insurance company ends up starting a policy and then you only find out at a later stage that the premium is not the way that it was supposed to be, or it's increasing at a higher rate than what you expected? Or you're getting to find out that there were certain waiting periods that you were not made aware of. Now, all of this is what I call the fine print. Now, in the insurance company's defense, there's quite a lot of information, and it's hard to give all of that information at one sitting, at one session. But they also rely on financial planners in order to be able to provide you with that information. But sometimes it's not explained well, or it's just not provided at all. But in this video, we're going to be going behind the scenes to have a look at those important information that you should be mindful for. And I want to kick this off with, I think, the most important element that you need to consider when it comes to premiums on your policy. And this is what the insurance company calls premium patterns. Now, this can be extremely confusing. So as usual, I'm going to explain this in the most simplified way. And I want you to comment below if you have a good, solid understanding of it, because this is one element that I believe is a key element in securing the most efficient life cover policy. So let's use an example. We are going to say that you want to purchase life cover, and the amount of cover that you want to buy is R1 million. Now, this would apply to all different types of benefits, but in our example, we're just going to be working with life cover policies. So we are assuming that you want to buy a death benefit. It's a life cover for R1 million. Now you notice I've put a flat line here. And in this flat line, I am making the assumption that the cover stays constant. So it's not increasing. Your R1 million is not increasing, it's not decreasing, it's staying the same. And then I want to use an example in terms of the premium. And let's assume that the premium for this is 500 rands. So I'll put premium on this end, so you get to see it, and up on this end, I'll call this cover. So now you're getting to see the premium is 500 Rand and the cover is R1 million. So let's recap. We're saying if you want R1 million cover, the price you should be paying in our example is 500 Rands. Now, if your 500 Rand is not increasing, then the R1 million is not increasing. Or said in another way, if you did not want to increase your R1 million, then your premium of 500 is not increasing. So 10 years down the line, you still have R1 million and you still have 500 Rand as a premium. Now, where's the secret coming in? Because the profession is so competitive, so the insurance companies are all trying to offer you the lowest premium. And sometimes it's us as consumers, we're always looking out for how can we get the lowest premium possible. So then the insurance companies introduce what they call these premium patterns. And one of it is this. They could tell you, look, we would now charge you, again, using an example, say 350 Rand. So it's 350 Rand, but you're still able to get the same R1 million cover. That's a good deal, isn't it? You have R1 million life cover. Now you're just paying 350 for it. Behind the scenes, what the insurance company is saying is, in order for them to make this possible, they would want to increase your cover, let's say at 5%. And then naturally, because your cover is increasing at 5%, the premium would increase at 5%. But then there's an extra increase here on the premium side. And I'll put that increase here plus 5%. So again, we're using examples. I want to recap this for you because it's a critical point and I want to make sure you're getting this well. So what we're saying is, if the insurance company is going to increase your cover at 5%, naturally it means your premium must then increase at 5%. Now, because they're charging us a lower price here, they are now saying, I'm giving you, in inverted commas, a discount. So I'm giving you a discount, a preferential rate, but I'm going to increase your premium at a higher rate every year in order for me to make this affordable. So you'd notice you've got your cover increasing at 5%, but the insurance company is increasing the premium at 5%, plus, because they gave you a discount in the beginning, there's an extra increase to recover back that discount. So what then takes place is this. Your premium in this aspect, let's use a different color. It starts off here, and then it starts to grow and grow and grow. So you notice over a period of time, you get to a break even where you should be paying the cover that you should be paying. But then the premium is still increasing because remember your premium increases at 10% and your cover is only increasing at 5%. So where you've got to be extremely mindful here is over a period of time, you started off with a low premium, but it's actually going to become a lot more later on. So more than what the level premium would have worked out to. I hope that one makes sense. You can always rewind this or move a few minutes back to watch this one again if you need the clarity. But this is one of the reasons that a lot of people complain that the policy becomes too expensive later on. Now, in addition to this, there's one step above where the insurance company can say, look, we are going to reduce the premium. We'll make this premium to be $275. So notice it's a significant drop from the initial 500 Rand. So it's now 275. You're still getting R1 million cover. So what are they doing different in this case? What's different is they now are giving you the 5% that you're used to, meaning this 5% when your cover increase is here. But in addition to that, they're linking this to your age. So each age band has a percentage that's linked to it. Let's say from 20 to 29, there's a percentage. 30 to 39, another percentage. 40 to 49, and so on. Now, as you get older, that percentage increases. Let's use an example. Let's assume that you are aged 30, and the percentage increase for age 30 is 5%. Now, that would mean you have 5% here, plus your age increase of 5%. It means you've got a 10% increase, and it goes up every year. But when you move to 40, now the age has changed. So it's 5% here, and let's assume 40 is a 6%, which means you have an 11% increase in premium. And as you move older to 50, this could be 12%, 13%. So what tends to happen is in a shorter space of time, you will get to break even, and then the point where the premium becomes more expensive. So notice the pattern. If in the beginning they start you with the price that you should pay, then it stays constant. Alternatively, you can ask or get a lower price if you just link this to sort of like a 10% increase. If you want an even lower price, then they'll link it to your age. It's going to make your policy to be the cheapest in the beginning, but your increases going forward would be the highest. And this is what I want you to be mindful of, because in your policy, you need to ensure that the policy remains affordable for you for as long as you live. Because if you don't, and you end up canceling the policy, there's a very good possibility, because if it's a pure life policy, that is, you don't get any money back. It's sort of like your car insurance. If you cancel, you're not getting any money back, but you enjoyed the cover for that period. So this is critical. You've got to look long term. Now, I want to show you another secret here, and that is, how do we make this work in your favor? You could say in the beginning that if all you needed is R1 million life cover, then yes, and you could afford 500, then you can go this route because it makes it affordable for you in the future. But what happens where you actually need R2 million cover? So let's use an example. You need to have R2 million cover, and now the price for R2 million is, let's say, 1,000 Rand. It's a lot more than what you want to spend. So suddenly you have a situation where you need so much of cover, but you can't afford that much of cover. So what happens in a case like that? Well, this is where you can sort of manipulate the insurance company's premium patterns to make things work in your favor. So you could manipulate it. So you could tell them, look, I want 2 million, but link my policy to a 10% increase every year, or link my policy to an age-related increase, which then means you're still getting 2 million, but your premium has been dropped down, which makes it affordable. Now, how does this be beneficial for you? Well, if you had to pass away, your family now gets 2 million Rand in this example, and you paid a very small premium to the insurance company. So you are winning. But over a longer period, you want to constantly be reviewing and assessing this policy to determine that it is still affordable for you and that you are still getting good value for money. So you can always start off with a premium pattern that is suitable for you. So you swing this in your favor and then adjust this later on so that it doesn't become too expensive. So that's one of the secrets that I want to share with you in terms of how the insurance company has what they call premium patterns. Now, in addition to this, you want to be mindful of things like waiting periods, which is the period of time that the insurance company will take before they actually make a payment to you. Now, I'll get into waiting periods on a separate video, but for now, I'd like to know from you, how beneficial has this been for you in terms of understanding the premium patterns of an insurance company? And if you are structuring your new policy, which pattern would you be leaning toward? Would you want to pay a level premium, or would you want to ensure that you are maximizing the benefit that you're getting upfront by having a lower premium, by having the lowest premium now and making sure you have the full amount of cover? Also, if you are at a point in your life where you don't need so much cover, I'm curious to know, what's your strategy? Are you going to go back to adjust your premium pattern with the insurance company? Maybe get this back onto level terms so that the premium remains affordable for you in the years to come. So comment below and let me know what your plans are in terms of your premium patterns and how you use this information to adjust on your policy. Now, if you've not already done so, remember to subscribe to the video so that you're able to get the information on this series as soon as we bring out new content. And on the next video, I'm going to be going through a lot more of the fine print. So we're going to cover something called waiting periods. So we're going to understand what are the different waiting periods and how can you prepare yourself in that instance where you're wanting to make a claim and then you're having to be stuck by waiting periods. See you then.